Corporate finance practice problem using OneNote. Dividends versus investment analysis. Get ready. It's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then in the 1825 Dividends versus Investment tab. Also note, when using OneNote, look at the immersive reader. Our presentations will be down in the text area as well, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations then on down below. We're looking at a decision-making process from the standpoint of a corporation to take the cash that they have and either invest it where they can get a return in on it, or to give it out in the form of dividends to the owners, those being the shareholders, the stockholders, and then think about what's going to be the impact on the price of the stock under both of those decisions. Now remember, if you are the owner of the corporation, either one of these decisions may be good to you depending on what your expectations are of the corporation that you are invested in. Obviously, if they take the money, give it to you in the form of dividends, that's nice because then you have the dividends. And if you're in a situation where you prefer dividends, you want to get paid back, that's good. But if they take the money and put it back in the company and they get a substantial return on it, they should be then increasing the equity in the company, which should increase the value of the company, which should increase the stock price. And we, as the owners of the corporation, then have an increase in value in that way as well. So in some ways, this decision will be different from corporation to corporation depending on who their owners are as to what the impact on the stock price will be. So here's the information. We have the earnings, which would be like the bottom line of the income statement, net income, 816,000. We have the shares outstanding. So we have the unit shares, basically ownership, of course, of the 300,000 standard units of ownership out there, shares outstanding. The price earnings ratio, otherwise known as the PE ratio, is at 20. Cash to invest or pay out. So this is the factor that we're making a decision on. We have this cash that we could, in our decision, is either to give it out in the form of dividends, taking our earnings in the form of cash and distributing them out of our company, reducing retained earnings and then increasing, giving it to the company. Or we take that money, we put it back into the business, and we think we can get a return on it of 14%. This will also, of course, depend on the stage of growth that the company is in. So in order to think about whether or not we should take that money and reinvest it, we need to think about whether or not we can get a return on it. If we're at a growth state in the company, then oftentimes we're wanting more capital so that we can take that capital, invest it in buildings, equipments, and so on so that we can get a return on it. However, if we're at a mature state in the company where we're basically doing what we need to do, we have the major infrastructure we need to do what we need to do, we don't have big expansion plans, then possibly we might not be looking for a big return on the added money. We might then be okay with basically giving the dividend. So it'll depend on the cycle of the company as to what the rate of return would be for the reinvestment, how much the company is growing at that point in time, and so on. But that's the decision. We either take that 440,000, give it out in the form of dividends, or we reinvest it. If we reinvest it, we think we're going to get that 14% return on that investment. So notice when we invest it, you're not thinking investment necessarily in stocks and bonds by us, the corporation. You're thinking investment in something like equipment, buildings, so on and so forth, typically to increase the revenue, to generate revenue on those assets. So if funds invested, PE ratio would not change. So we're gonna say that if we invest the funds, the price to earnings ratio is not going to change. Remember, when you're thinking about the price to earnings ratio, you're thinking about a component price being a component that's going to be driven by the market. So we're looking then at something outside the control of the company. We're projecting that the market is not going to change the PE ratio for this adjustment. And then down here, we say that if the funds are paid out in dividends, the PE ratio increases by 10%. That would be because we assume here that the market is going to react favorably to dividends, the market then preferring dividends, liking the idea of getting money back on the investments, possibly as proof or something, validation that they're getting dividends. So that's going to have an impact on the PE ratio. But of course, it'll also have an impact on income because we're not going to get that 14% return we would have got otherwise if we took it and invested it, back in the company. So let's see what will happen here. We got the earnings after the investment. So let's think about the investment process. If we were to take that money and invest it, we have the starting earnings. This is our net income in essence before we do this action of the $816,000. Then we're thinking we're taking that cash, and instead of giving it out in dividends to the owners, we're going to reinvest it. We're going to get a 14% return on it. So therefore, we're going to get 440,000 times 0.14 or 61,600 of the added earnings. We're going to take that. We're going to add it to the earnings we had before, 816,000. That's going to give us our 8,776 on the earnings after that investment. So then, what's going to be the earnings per share once that has taken place? We have the earnings after the taxes, the 877,600 that we just calculate. We have the shares outstanding, as we saw up top of the 300,000 shares. So if we take that amount of earnings, 8,776, divided it by 300,000, we're going to get the earnings per share, the EPS of the 2.93 about. Then we can think about the stock price. Stock price can be calculated, and note, you might do this by looking at, we're going to use that price earnings ratio. Now you might just actually write down the equation for the PE ratio, price to earnings, and you could do that on an aggregate basis or on a unit by unit kind of basis, and then back into the unknown, then do the algebra, which we're basically doing here, now solving for price with the use of the PE ratio. So we have the price earnings ratio at the 20, earnings per share that we calculated at the 2.93. Now remember that price earnings ratio takes into consideration to some degree market, what the market thinks, given the fact that the price driven by the market. So we're going to then say, okay, that means that we got the 20 times the 2.93, it's going to be the 58.51. That's the price if we were to invest, given this information. Now let's say, well, what would happen then? What would happen then to the price if we took that 440,000 and gave it out in the form of dividends? Well, then the earnings under that plan would be the same. We don't change the earnings because we didn't get any more earnings because we gave the money away instead of reinvesting it where we would have got that 14% gain on it. So we don't have as much of the earnings. But we also know that the owners of the company, the shareholders, like us giving them money in the form of dividends distributing, and that means that they're going to change the PE ratio, we are assuming, given the fact that they're interested in those dividends. So we're going to take the earnings, which are less now, of the 816,000, the shares outstanding still at the 300,000. That's going to give us our earnings per share of the 816,000 divided by the 300,000, 2.72. Then we can use that to calculate the stock price using the PE ratio. Now, we said the PE ratio is going to change this time because the market conditions are going to change because they like dividends, that we're assuming. They may not always like dividends, depends on the company itself, but we're going to say, a lot of times the owners like when you give them money from the company in the form of dividends. So that means we're going to say it's going to increase by 10%. So obviously we're going to take the 100% or 1 plus the 10%, 0.1, 110% or 1.1 times the 20%, increasing that 20% by the 10% to the new PE ratio that we're going to say is 22%. 22% times the earnings per share, which we calculated up top to be that 2.72. So I'm taking that 22 times 2.72, and that's going to give us then our 59.84. Therefore, so we got the 59.84 under Plan 2, and we've got the 58.51 under Plan 1. So it looks like Plan 2, given the dividends out, is actually resulting in a higher price determined by the market, even though we're going to have a less on the earnings per share because, once again, the market is valuing the dividends at a higher threshold, and again, that would be determined in part by the market itself. So if we had the recap down below, we got the stock price versus the stock price, and again, the second stock price that we came to was better. So just a quick recap. The first option, we took that $440,000, we invested it, bought stuff like assets that we think we're going to get the 14% return on, increasing the earnings, which has a positive impact on the earnings per share and the result on the stock price. And then we said, well, what would happen if we were to take that, give it out in the form of dividends? Doesn't increase the earnings, does not, get that increase in the earnings per share, but it reflected on the market positively because the owners liked that. And in this case, we're saying that the second option, giving out the dividends, actually resulted in the higher value assigned to the company by the owners, the shareholders, by the market.